You know, when a tech company grows up, it usually gets kind of boring. It stabilizes, the CEO starts wearing a tie, and the stock just settles.
Yeah, predictable.
But looking at Robinhood Markets, boring is definitely not the word I would use.
Far from it. It's been more like a roller coaster that decided to become a bullet train halfway through the ride.
And that's exactly the tension we're looking at today. Robinhood is trying so hard to shed that 2021, whole meme stock casino thing.
Right, for Dogecoin and GameStop.
They've built this huge diversified financial services company, but, and it's a massive but, in this Q4 2025 report, they seem to be caught in a crossfire. You've got a booming stock market on one side and a freezing cold crypto winter on the other.
It's a classic identity crisis. I mean, they've built this super app, but when a main pillar like crypto starts to crumble, you have to ask if the whole foundation is actually stable.
Exactly. Is the strategy working, or are they just shuffling things around? Before we dive in, this analysis is brought to you by StockAnalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at StockAnalytics.ai. Now, let's get into it.
Let's do it.
So we're working from the Hood Earnings Analysis Report for Q4 2025, and our mission today is pretty specific. We need to decode this mixed verdict from Wall Street.
Yeah, it's a puzzle.
The company announced record profits, but the stock immediately dropped, 6 or 7%? That disconnect is what we need to solve. Why punish a company for making money?
It's the billion-dollar question. On the surface, the numbers look like they contradict each other. You see profits, stock drops, options trading explodes, crypto activity falls off a cliff. It's a messy picture.
All right, let's stop guessing and look at the scorecard. Let's pull up slide 1, the at-a-glance scorecard. Give us the headline numbers.
Okay, so top line first. Total revenue came in at $1.28 billion. That's up at 27% year over year.
See, that's where I get stuck immediately. 27% growth for a firm this size is usually amazing. I mean, most banks would kill for that.
In a vacuum, yes. But in this game, it's not about reality, it's about expectation. Wall Street wanted $1.34 billion.
So they miss.
They missed the revenue target by about 4.5%. And in this market, if you miss the top line even a little, the algorithms just sell. It signals a slowdown.
Okay, so a revenue miss. But then I look at the bottom line, the earnings per share, or EPS, and they absolutely crushed it.
They did. The street expected 60 cents a share. Robinhood delivered 66 cents. That's a 10% beat.
Okay, hold on. This is where the math feels weird to me. How do you bring in less money than expected, but keep more profit?
Well, it comes down to efficiency, which we'll get to. But before we celebrate the profits, there's a giant elephant in the room with their net income.
Right.
If you look at the year-over-year chart, it says net income dropped 34%.
I saw that, $605 million in profit, which sounds great, but it's down a third from last year. How is that a record year if profits are tanking? Is the business actually shrinking?
No, and this is so crucial. This is where headlines can really trip you up. It's what we call an accounting illusion.
An illusion? That sounds a little shady.
It's perfectly legal, just confusing. So back in Q4 of 2024, Robinhood had this massive one-time benefit, a tax asset valuation allowance. It was worth about $424 million.
So like a giant tax coupon from last year that inflated the 2024 numbers.
Exactly. It wasn't money they made from operations. It was a paper adjustment. So if you strip that weird one-time thing out and compare apples to apples, their core profitability didn't drop.
It actually grew.
It actually grew by about 23%.
That completely changes the story. One headline says shrinking, the other says growing by double digits.
Precisely. And that's why the EPS beat is so important. It shows the actual business is working better than ever. But the market's reaction, dropping the stock from $85 to $80, tells us investors aren't worried about profit right now.
They're worried about growth.
They're looking at that revenue miss and thinking, can you keep growing if crypto stays dead?
It's always, what have you done for me lately? Okay, so the profitability is real. I want to look under the hood now at how they're making this money. Let's move to slide 2, the engine of profitability.
This is my favorite part of the report because it really shows you the mechanics. And for Robinhood, the efficiency is it's staggering.
The number that jumped off the page for me was the net profit margin, 47%.
It is absolutely elite.
Just to ground this for everyone, does that literally mean for every dollar Robinhood brings in, they keep 47 cents as pure profit?
That's exactly what it means.
That seems impossibly high. How does that compare to, I don't know, a normal bank?
A bank is maybe 20, 30% on a good day. A grocery store is lucky to keep 2 or 3 cents on the dollar. Hitting 47% is exceptionally high. It gives them this huge safety cushion.
And the adjusted EBITDA margin, that's stable at 59%. But I saw something interesting on the expense side. Revenue grew 27%, but their adjusted expenses only grew 18%.
And that gap right there,
Yeah.
that is the textbook definition of operating leverage.
Okay, break that down for us. Why is that gap so important?
Sure. Think about it. Once you build the app, adding the millionth customer doesn't really cost you much more than the first one did, right?
Right, no new factory to build.
Exactly. So as your revenue climbs, your costs stay relatively flat. That leverage lets your profit just explode way faster than your revenue.
They're getting more juice out of the squeeze.
That's it.
But I have to play devil's advocate. If they're so efficient, why did total operating expenses jump to $633 million? I mean, that's up 38% year over year. That's a huge jump.
It is, and it's a valid concern, but you have to look at what they're spending it on. The report says it's for marketing and growth investments.
So buying customers.
They are. And they're also integrating new acquisitions like Trade PMR and Bitstamp. Management is basically saying, look, our margins are huge. We're going to spend some of that profit now to lock in future growth. It's a calculated bet.
Got it. And there's one other new expense here, taxes.
Ah, yes. The free lunch is officially over.
Last year, they had that huge tax benefit. This quarter, they paid a $56 million tax provision.
Welcome to the big leagues, Robinhood. I mean, it's a drag on the net income comparison, sure, but it's actually a sign of health. You only pay taxes when you're making real money.
Fair point. Okay, so the engine is efficient. Let's talk about the fuel. Let's break down the actual business lines in slide 3. The engine room business segment performance.
I like to think of their revenue now as a three-legged stool. And this quarter was the ultimate stress test because one leg got kicked out from under it.
Let's start with the strongest leg, equities and options. This was the boom, right?
A huge boom. We had that massive bull market in late 2025, and people were trading. Options revenue hit $314 million, up 41%. Equities revenue was up 54%.
54% growth in stock trading revenue is just wild. For a while there, the story was that the retail investor was dead.
Right, that they all lost their stimulus checks and went home.
But this proves they are still here, and they are actively chasing this rally.
It really confirms that retail participation is sticky. Once people start, they tend to keep going, especially when the market is hot.
Okay, so stocks were the hero. Now for the villain. Leg number 2, crypto.
The bust. Crypto revenue was $221 million. That's down 38% year over year.
That's a painful drop.
It's brutal. And it's not just revenue. The notional volume on the app crashed 52%. So the amount of money changing hands was cut in half.
Here's my question, though. If this was 2021 and crypto volume dropped 50%, Robinhood stock would have gone to zero.
Oh, it would have been catastrophic. They were a crypto company with a stock feature.
But this time the stock only dropped 6%. Why?
Because of leg number 3, the prediction markets.
This is the part of the report I found most fascinating. Under other transaction revenue, they logged $147 million. That's up 300% year over year.
It's the new star of the show.
And it says this was driven by 8.5 billion event contracts traded. Billion.
Think about the psychology. The crypto market was boring, sideways. But that speculative energy has to go somewhere, you know. It's like water, it finds a crack.
So it went to betting on elections and weather and Fed rates.
It's like the gambling energy just shifted rooms in the casino. People got bored at the crypto wheel, so they moved over to the craps table.
That's a cynical way to put it, but yeah. And from a business perspective, it saved the quarter. It proves they can monetize engagement even when crypto is dead.
They diversified their speculation menu.
Right. And we can't forget the boring part that makes the steady money. Net interest revenue.
The unsung hero, $411 million, up 39%.
Now, wait a second. Interest rates have been falling. The Fed has been cutting. Usually a broker's interest income goes down when that happens. How is theirs up so much?
Volume, pure volume. Their margin book, the loans they give to customers to trade with leverage, it doubled. Up 113% to $16.8 billion.
Wow. So customers are borrowing twice as much money to trade as they were a year ago.
Yes.
Isn't that terrifying?
For the customers? Potentially. Leverage is a killer. But for Robinhood, it's incredibly profitable. They get the loan interest and the trading fees. It's a double dip.
So they're banking on their customers taking on more risk. And finally, subscription revenue from Robinhood Gold.
Yep, up 56% to $50 million. They have 4.2 million subscribers now.
And that matters because it creates a revenue floor, right? It's predictable.
Exactly. It makes the business model much less fragile. It's steady, recurring cash in a very volatile world.
So the business is diversified, It took a punch and kept standing. Let's look at the balance sheet behind it all in slide 4, financial strength and shareholder rewards. Because in this market, cash is king.
And Robinhood is sitting on a throne. It's a fortress balance sheet. $4.3 billion in cash.
That's a lot of dry powder. But the stat that blew my mind was the asset inflows. Net deposits were $15.9 billion in Q4 alone.
For the full year, it was over $68 billion.
How does that growth rate compare to the giants, to a Schwab or a Fidelity?
Well, obviously they're smaller in total size. But the rate of growth. Robinhood is growing assets at 35% annually. The industry average for the legacy guys is maybe 3 to 5%.
So they are growing 7 times faster.
They are winning the asset war. And that's the scary part for the incumbents. They're not just getting the small accounts anymore. They are getting the serious money, the 401k rollovers.
And with all that cash, they're buying back their own stock.
$100 million worth in Q4.
But here's where I get skeptical. The report says the average price they paid was around $119 a share.
Correct.
And the stock is trading at $80 right now.
Ouch.
Did they just light $30 million on fire? Why buy at the highs?
In the short term, yeah, it looks like a bad trade. But you have to look at what it signals. Management was willing to buy at $119 because they think the long-term value is way higher.
It's them putting their money where their mouth is.
Exactly. And it also offsets all the stock they give to employees.
Yeah.
So as a shareholder, your slice of the pie isn't getting smaller. That's a shareholder-friendly move.
Okay, strong balance sheet, diversified revenue. But investors buy the future. So let's look at slide 5, the road ahead management's outlook and key takeaways. What's the team telling us?
The tone is very confident. CEO Vlad Tenev just keeps hammering this idea of the financial super app. He's focused on shipping new products.
And the CFO, Shiv Verma, said 2026 is off to a strong start.
Which is basically corporate speak for, please don't panic about crypto, January looks better. He's trying to calm the nerves.
But there is a risk in the guidance for 2026. They're projecting expense growth of around 18%, pushing expenses to almost $2.7 billion.
This is the big pivot. They're shifting back into investment mode. For 2 years, it was all cut costs, get profitable. Now that they're hitting the gas again.
They're betting $1 spent today will make them $2 tomorrow.
Right. But it is a risk. If the crypto winter continues and revenue stays flat, but they increase spending by 18%, those beautiful 47% profit margins we just celebrated are going to get crushed.
So they need the growth to show up to justify the spending.
Precisely. They're betting on themselves.
So bringing it all together, what's the final verdict on this quarter?
I'd call it an inline quarter, with the super app hedge working perfectly. Crypto tanked, but the company still grew revenue 27% because of options and prediction markets.
It proves the model isn't broken just because Bitcoin is down.
Exactly. Execution on costs was flawless. Product rollout was flawless. But, and this is the big takeaway, they are still tethered to crypto volatility. They can mitigate it, but they can't escape it. If crypto stays cold, 2026 is going to be a harder year.
It's a wild ride, but it seems like a much sturdier vehicle than a few years ago.
Absolutely. Feels like a real business now, not just a fad.
Before we wrap up, I want to leave you with one final thought. We touched on it, but I can't stop thinking about the explosion of these prediction markets.
The event contracts.
Yeah. Robinhood basically got millions of users to pivot from trading crypto to trading, well, events, elections, weather, 8.5 billion contracts, just a staggering number. My question is this. Have they accidentally created a new asset class that's even more engaging and maybe more addictive than stocks?
It's instant gratification, right? You don't have to wait 90 days for an earnings report. You find out if it rained or not, instantly.
Exactly. It gamifies reality itself. And if this is their true future growth engine, Wall Street might be severely undervaluing it because they still see it as just a stock app. But if they're becoming the everything exchange, that's a whole different valuation.
It definitely changes the definition of investing.
It sure does. All right, just a quick reminder for everyone, this deep dive is for informational purposes only. We're not giving financial advice. You should always do your own research. Also, this analysis was generated with the help of AI.
Always double check the data.
Absolutely. Yeah. And speaking of data, want institutional grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings. Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.